The stock market is at a crucial point. It's trying to decide whether it's going to break through and continue on upward in a reestablishment of the bull market, or whether we've reached a double top and it could crash. What seems to be saving it is artificial intelligence, and I think artificial intelligence is saving the stock market. And I'm going to show you 3 simple ways and safe ways to participate in artificial intelligence without risking too much. Looking at the chart of the S&P 500, which is probably the best representation of the overall stock market for the last year, when you look at that, what you see is a double top. We went down about almost 20%, and then we had one of the fastest recoveries in history, and now we're just starting to peak above it. And the question is, when you get a double top, there's always a danger that you're going to come back, but we have started to peak above it, and I think artificial intelligence is going to carry it further upward. Things were getting so ridiculous with Trump that I decided to completely get out of the stock market in February, and that's why you haven't heard from me for a while. It just was getting so ridiculous. Each headline could just totally blow whatever trade you were in. And I am a trader, but I also do a lot of swing trading, and I will stay in long term if we have a definite trend. And with Trump, he is so disruptive and so unpredictable. But there is the chance that what he's doing might work out. He's basically trying to move taxes down and increase tariffs. And so you will pay less taxes, supposedly, but you will probably pay more for products, which happens with tariffs usually. So I think there is hope with Trump to the extent that he's shown that he can be reasonable, to the point that they call him the taco man. Trump always chickens out. And that's probably an exaggeration, but he does moderate. And what seems to make him moderate is when he sees the stock market tanking badly. So there is hope with this, but I think the main hope is with artificial intelligence, which seems to defy whatever Trump is doing. As you will see, especially with the 3 ETFs that I'm presenting, that my philosophy is more or less, I'm going to go big or go home. And to start off with, we should first talk about NVIDIA, which is the main artificial intelligence stocks. It's worth almost $4 trillion, $3.85 trillion to be more exact. As you look at the chart, you can see that it's now about 7% above where it was before the recent crash. So it seems like it's starting a breakout, and that's why I'm enthused about it. Its relative strength is 76, which is good on a breakout. Its price to earnings is 33, which is not high for a breakout technology stock like this. Its earning growth rate is an outrageous 38%. So I think we have lots of good things coming from this. And especially if you're in your 30s, 40s, 50s, I'm old, okay? But if you're young, and even if you're in your 70s, you might live until you're in your 90s. So I think it's both a good short-term and a long-term investment, unless Trump goes completely crazy. And I don't think he's going to, because he's shown signs of moderating in the face of adversity. The easiest way to invest in technology and get exposure to artificial intelligence and all the big mega cap companies with some diversification, as we shall see, is to invest in the triple Q, the QQQ. The qualification to be in this is that you're one of the 100 top market capitalization stocks in the NASDAQ. So the largest 100 stocks in the NASDAQ. I put a trailing stop loss of 4% on all my trades. That simple rule has saved me so much money, and I urge people to consider doing that. Looking at the holdings of QQQ, the top 10 holdings, which are 50% of total assets, and you'll notice that technology is in the sector weightings. Technology is 52% of the fund. Now that's pure technology, okay? But they also have communication services, and communication services tends to be technology related. So if you combine those two, you can say 2/3 of the QQQ is in technology or technology related. When you look at the top 10 holdings, I think what they have there should be called the Magnificent Nine. The only one that isn't technology is Costco Wholesale Corporation, COST, which is only about 3% of the fund and is a retail stock. All the rest are heavy technology. They're the mega cap technology stocks. But you get good diversification with a third of the fund being not technology. Part of the reason for owning ETFs like QQQ is I think it's almost impossible to pick out which of these 9 are going to do better than the others. Now, the 2 top contenders, of course, are Microsoft and NVIDIA. And Microsoft has almost as big a market capitalization as NVIDIA. It's 3.69 trillion. To be exact, but it's closing in on that 4 trillion, like NVIDIA is. NVIDIA is just slightly ahead at 3.85 trillion. But I mean, you got these other wonderful companies: Apple, Amazon, Broadcom, Meta, Netflix, Tesla, and Alphabet. The TQQQ is the only fund that I use to day trade with. It's a triple leverage of the QQQ. So for each dollar that you have in it, you get $3 of return. If it goes up $1, you get $3. So it's a very bullish fund, and it's good for day trading in a bullish phase because you want the variability. You want it to jump if you're day trading. And I do not leave this on overnight with President Trump being president. He is so unpredictable that literally you have a couple hours maybe. At least that's the way it's been so far. Maybe things will settle down once the tariffs get solved. But my experience, and I think the experience of the world, is that tariffs take a year or 2 to settle out. Now, I don't know if it's going to take that long this time, but there's significant disruption constantly from Trump, and it's headline news. And it can be, if you're doing it by the hour and by the minute, and when Trump's president and when I'm trading TQQQ, I'm on it every second, okay? And it's a very short-term trade, and it's take the money and run. And I seem to have a talent for it. I've made as much as $500,000 in a year doing this, and actually, in some years it's been more profitable than trying to hang on to a portfolio, because the market has been so disruptive since the health problems we had in the country. it's been so up and down that it's hard to hold for a couple of days. And with Trump being president, I'm looking minute by minute. The Fidelity Enhanced Large Cap Growth ETF, FELG, is much like the QQQ. The significant difference is that it's actively managed by Fidelity, which in my experience, Fidelity usually does a pretty good job of managing their funds. So I'm probably most attracted to this fund, and I have significant money in both this and in the QQQ. In the few weeks I've been in it, it's doing slightly better than the QQQ, which is what I expected. When you look at the holdings, they say the top 10 holdings. It's really the top 9 holdings because Alphabet is listed twice. The symbols are GOOGL and GOOG. In my experience, most traders trade GOOGL, Google, because that's the Class A shares. So it's really the Magnificent Nine. And I think some of the discrepancy between the top 10 holdings and the technology sector weightings is because I think they're considering some of these like Netflix and maybe Meta too as being communication services. So you get some discrepancy, but like I say, I combine technology and the communication services. So it's like 2/3 of the fund, probably, or around there, is either technology or technology related. And I like the idea that it's being managed actively by Fidelity. My third ETF is Van Eck Semiconductor ETF, SMH. And if you look at the sector weightings, this is easy. It's 100% technology. And it only has 2 really big mega caps, NVIDIA and Broadcom. And the rest are semiconductor companies, which are significant companies, but they tend to be smaller, and it's pure semiconductor technology hardware. Because it is 100% technology and 100% semiconductor, you had better be in a good spot with semiconductors. And I think we are right now. But I have about $50,000 in this ETF, and I have about $100,000 in FELG and the Triple Q. So I see this as riskier with more potential upside, but having significantly more risk. Looking at the chart, comparing the 3 different ETFs, you can see that the Triple Q and FELG have done similarly. They've both done a little bit over 14%, while SMH, the more risky fund, has only done almost 7%. So it is more risky, and I have a stop loss, a trailing stop loss, a percentage on these of 4%. If it goes down 4%, it's time for me to reconsider whether to get back into it or not. Right now, I see the market at a critical point and is trying to decide whether it's going up or down. To me, it looks like it's starting to break out. And the area that seems most confident in going forward and having future prospects of growth is artificial intelligence. There is a question as to how many human jobs it will take and how much can we trust it. Would we trust it to be a doctor, for example? But there's no question that it's already very significant and important in any type of managerial office work or computer work. That's without question. So I will day trade about $200,000 at a time when it seems appropriate, and it's a very day trade specific event, and conditions have to be right because of the uncertain headline precedent that we have. And I think the ETFs, basically, we have 9 magnificent mega caps that it's hard to decide which one is going to go forward. And the best bet is that they're all going to go forward if conditions are decent. Artificial intelligence is a big deal, particularly for the United States. We are the number one investor in artificial intelligence with $471 billion, almost $500 billion in artificial intelligence. China comes in a distant second at $119 billion. Great Britain comes in third at $28 billion, and all remaining countries have $15 billion or less in artificial intelligence. So it's of particular importance for the United States. Thank you for listening. Just a friendly reminder that this is not financial advice because I do not know your personal situation. You need to do further research and gather further information to decide if the investments I present are right for you.